We have an interesting kind of a news flash to talk to you about today.
Yeah, so the debt ceiling is in the news again. And we've had some clients messaging us this morning, hey, should we be worried about this? So we thought we'd take a brief moment to chat about it. Interestingly, this morning, NPR News came out, what should you do as a consumer to protect yourself against the debt ceiling? And their advice was, pay down your credit cards in case interest rates go up and save your money. I mean, how about call your politicians and scream at them? Like, why is this on the consumer to deal with? I mean, it's just...
Yeah. No, we wouldn't do that. We're not going to touch them. Let's talk a little bit about the history of this whole debt.
Yeah, what is it and why are we dealing with this?
Why are we dealing with it and why is this such a big deal?
Yeah,
most people don't really understand. Other than they're frightened, but they don't know why.
Yeah. And you probably remember the day it was created during World War II.
Oh,
no, World War I.
World War I? Oh, it's even worse.
Just kidding. So it was created in World War I. Prior to that, Congress would just vote on spending issue by issue. And then the war happened and we needed tanks and boots and guns and clothes. And they said, oh my gosh, like we can't do this issue by issue. So they said, all right, let's just cap how much we can spend at a time. Go for it. And, we'll see what happens when we hit the wall. Well, they hit the wall like every year and they have to go and raise the debt ceiling. This is simply a formality. And what do you think? Like since the 1960s, how many times has the debt ceiling been increased?
Most people would have no idea.
They don't. Yeah.
Like they think 6 or 7.
Yeah. Right. It's the number is 78 times.
78 times.
And you heard about it probably 3 times.
Yeah. Right.
Right. So what's changed? In the last 2 decades, our politicians have figured out that they can basically hijack the debt ceiling for their own issues. And they're essentially playing chicken with our borrowing limit and saying, hey, I'm not going to approve that unless you get this little side bill in here for some town in Iowa, or, my issue, my party's issue. And it's becoming more of a partisan, game of chicken, essentially. But what they're doing is playing chicken with your Social Security payments, your bond interest and repayments, government workers, military salaries.
Interest rates overall in the economy.
Yes.
Right?
This game of chicken is wrong.
Yeah. Yeah. Plus, the interesting thing is we're one of only 2 countries in the entire world that even has a debt ceiling.
Yeah.
It's totally voluntary. We don't have to have this. The Congress could today vote to eliminate the debt ceiling and we'd never have this conversation again. But they won't. Why? Because they want to have something to fight about.
They can use this
issue. They can use it as a hammer.
But also, people hear the total debt. So we're at 31 trillion, I think, today. And they freak out because that's a huge number.
It's the most we've ever had, for sure, right?
Yeah.
It's terrifying to people.
It is. But let me change the perspective on this a little bit because it's actually not that scary. And so the real issue with our debt is the interest payments, right? That's like when it comes down to the wire, we got to make these payments. And when we think about the burden on society of the national debt, that's what we need to look at. And so if we look at the percentage of our total GDP, it's like all the output of our economy that we're giving away to this debt. In the 1990s, we paid 3.1% of our total GDP to service this debt. If you're watching this, you might be seeing a chart pop up on your screen. And it shows the total history of how this has gone since the debt ceiling started. So 3.1%, that's not that bad if you think about it.
You wouldn't be shocked by it.
No,
right?
not at all.
Right.
Not at all. So this morning.
But it must be much higher now, right?
Gotta be, right? We're at $31 trillion. So I polled the staff this morning, like, hey guys, what do you think it is today, percent of GDP? What do we get?
I mean, people thought 10 to 20% of our GDP because it's 31 trillion, right?
Yeah.
Right.
It is currently 1.8%.
Get out.
Of our GDP. And here are our congressmen screaming, we gotta stop this, don't you know? I mean, hello? Like, why? Go ahead.
Because the economy grew a lot. The economy's been a juggernaut and it's grown so big that the amount of debt is actually, and the paying the debt and supporting it and making the payments has become a much smaller piece of our overall pie.
Yeah. So when you put this into perspective, we're actually better off today than we were in the 90s.
But you're not going to hear that in the press.
I mean, I wouldn't watch that news.
We are going down. We're going down. The debt.
Right.
I mean, the debt. Let's clear it up. The debt is not a great thing.
Of course not.
You don't want to be maxed out on your debt. No one wants to have their credit card maxed out. But But it's not life or death.
Right.
Anywhere, no one's going to get freaked out that we're paying 1.5% or whatever it is, 1.8.
Right. I mean, what would happen? Like,
service.
We hit the ceiling and our interest rates double, so our payments double.
Yeah. Then we're at 3.5 or something percent. It's still sustained. In fact, we've been higher before in the 90s.
We sure have.
So we have precedent. We're not in a terrible situation. I think people would be. People watch our podcast a lot because they like to get different perspectives on things, right? And they learn things. Well, this is something you could take with you and talk to your friends about. We're not at the end of our rope. We're not going down because of our debt. It's high. It's higher than it's ever been, but so is the size of our economy.
Right.
So
and so what is going to happen? Because there is a real impact on people who are currently invested in bonds, receiving Social Security, invested in stocks. We already know they're going to let this go to the wire. And if there's nothing the stock market hates more, it's uncertainty. So you can expect to see some volatility. But now is not the time to start trading around that volatility. I'll just get out until they fix this and then I'll get back in when it's over. Don't play that game. If you're already in a well-diversified portfolio, you are set up to withstand these, minor fluctuations. I hope they're minor. We'll see.
Right.
That we're going to have in the market.
Yeah. And I think, it's helpful to remember back in 2012 when we had at that time they called it a fiscal cliff.
Oh, it's so dramatic.
The debt ceiling, but it was the same basic thing. And you may remember that they closed all the national parks. You couldn't go to Yellowstone. You couldn't go to these places because they didn't have any money. We survived it. The stock market did not like it. The market went down about 20% during that period of time. We got through it. Nobody even cares. It was a little blip in time. Nothing to overreact about. Can you imagine now thinking we overreact? I think the Dow is probably at 7,000 or something then, whatever.
Yeah.
It just wasn't, it wasn't a thing. It was at that time it was really scary, but it wasn't something you had to react to or prevent or get out of the market to get back in because you probably would end up getting back in at a higher price.
Yeah.
So just live with it. It'll be fine.
Yeah.
Relax. Part of the uncertainties about investing that you just can't get away from.